Hello and welcome to Investing Confidential. I hope you enjoyed that bear market rally that lasted most of January and part of February, but it's over. Okay. The economy is deteriorating fast, but more importantly, inflation is sticky, as we've been talking about. Inflation is looks like it's going higher. I do have one chart that every investor, whether you're in bonds or stocks, should be worried about. It's going to shock you. It's probably not surprising, but it will shock you, and I'll show that in a few minutes. But first, let's talk again about this U.S. data because the Fed says they're data dependent. You got traders, quantitative computers, AI, and also day traders trading the data. But as I'm going to show here, this data is misleading. Okay, let's look at the here again. Let's reiterate. Look at these participation rates. Okay, the trend has been going down for some time. We are at a point where all of this, a lot of U.S. data. Again, this is the data that the U.S. government, the Bureau of Labor Statistics, all these quasi government organizations have been compiling for years. Okay, this data is inaccurate. Okay, I don't want to say fake, but the government does nothing. Where's all this technology that we have? Where are these Silicon Valley guys trying to help the government out? I mean, this is a joke. We are relying on data that is totally misleading. Why worry about it now versus because we have a massive change, a generational change. Okay, 30 plus years of declining rates is over. Okay, that is over. We are going higher. We're going to have double the amount of inflation on average that we've had over 30 plus years. Again, this low inflation, it's gone. This was all false. It didn't work. This experiment didn't work. Okay. This is something I've been talking about for months with the data. As you can see here, as I mentioned, it's just misleading. Okay. Here's the most egregious example in the short term that we've seen so far. Okay. So the end of the bear market rally were these retail sales numbers. Okay. They came out, they weren't adjusted for inflation. Oh, wow. Look at retail sales. Look at this. Okay. Whoa. As you can see, food service leading the way. We have better sales. The economy is good. The consumer. No, 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 no. No, no, no. This is fake data. Okay. Absolutely fake data because it was released, not adjusted. So here's some real data. Okay. Open Table. What do you like? Whether you use Open Table, it doesn't matter. Open Table is a app. People make reservations. I use it, everyone uses. They have real data. Okay. Look at this. Seated diners crumbling. This is falling off a cliff. Okay. Sales are up slightly because of price inflation. I don't know if you've been to a restaurant lately, but in the large cities, I mean, go to a restaurant. I mean, the entrees are $40, $50. It's absurd. Okay. This is inflation. But the reality is people are not going out. So what's going to happen over time? Many of these restaurants are going to continue to close. They can't survive. People are not going to pay. It's too expensive. There's too much inflation. And so this data that you saw before about better retail sales in food, okay, this was misleading, totally misleading. Okay. So the bottom line is inflation is sticky and inflation is coming back. Okay. Despite what the Fed has been doing. Look at here, US PPI ripping higher. This is a leading indicator for inflation. This is one of the more accurate numbers that are out there. Okay. CPI, shelter. Look at this. This is again housing ripping higher. Okay. I don't know how accurate it is, but the trend is there. Okay, now again, Fed said they're data dependent. The Fed is watching this. Here, I mentioned this last week. Bullard now calling for 50 basis points. Another Fed, Mester, calling for 50 basis points. Right now, folks, the consensus is still 25, and the consensus is a pivot in April, May. At least it was last week. That's not happening. That's not happening. Here is the terminal rate. As I keep telling you, you have to watch this terminal rate. It's going to 6%. The 2-year is at over 4. The 2 years going over 5%. Okay. If I can get guaranteed compounded for 2 years, 5%, I'm going to put my money in that versus stocks. You have interest rates, declining earnings. Why not buy a 2-year piece of paper at 5%? Can't beat it. What is this? mean? Okay. All this stuff that I just spoke about, it means unemployment is going to get worse and it's going to lead to recession. To me, recession, as I told you, is baked in. Not baked in, but 100% we're going to have a recession. But let's start with unemployment. Look at the unemployment claims, right? Everyone's, oh, the economy can't go into recession. Unemployment is too strong. Again, this is bad data, misleading data, fake data. Okay, here's data from Challenger is another group, private group that does a job. They do a much better job than the government does about unemployment. Okay, they're forecasting unemployment is about to explode higher. It has to. Okay. We have seen these layoff announcements. I mean, it has to. And is that good? Some people say, well, if unemployment goes up, then the Fed will pivot. No, no, no. Inflation is the Fed's not going to pivot because inflation is sticky. The Fed will not be able to stimulate. Okay. They ever target 2% before they stimulate. They're not getting there. Okay, now let's talk about a recession. Okay, Deutsche Bank, which actually has decent economists, saying there's a 90% chance of recession. If you don't like Deutsche Bank, here's some more data. 60 plus forecasters, a lot of them are Wall Street, and you see Wall Street at the left side. Here's Goldman Sachs saying only 20%. All the Wall Street banks, they don't want recessions. They want to fool you. They want you to buy stocks. They want you to buy bonds off of them. They want you to buy whatever. Okay. Most economists, as you can see, inflation going higher and higher and higher. Okay. Here's CEO expectations. Okay. Expecting weak earnings. Now, these CEO expectations, okay, are fairly accurate. They know what their companies are doing. Again, these weak EPS trends is another great recession indicator, along with layoffs. Okay, but I don't have to go into that. You're seeing it. You see it every day. There's massive layoffs going on, and they are accelerating. Don't believe the morons at CM like Jim Cramer saying, "Oh, this is normal." Don't believe this idiot. Okay, layoffs are accelerating. Another leading indicator for recession. Okay, and recession, folks, is 100% now. There's no doubt in my mind. Okay, but what are the market implications? Look at the the forecasts. Okay, for Wall Street. Uh, all of them are pointing to weak returns over time. Okay, I mean, even the Wall Street guys can't get around that. Okay, you're going to have PE contraction, valuations, margins are going to be lower. Okay, sales growth forecasts again, they have a robust. These sales forecasts are not accurate; they're going lower. So the bottom line is the return profile for the stock market is going to be less than half it. Remember, we averaged, I don't know, 12% for the last 10 years. It's going to be less than 3%. So that's why I say if you can get 5% in a 2 year, which you're going to get really soon, it's going to beat stock market returns for sure. Okay. Here's another interesting thing. Equity factors. These are factors that influence stock prices. Okay. This tells you what to own and what not to own during recession. Okay. One thing, two blaring things. You got to get a high beta. What is high beta? That's tech stocks. Okay. Anything high beta, anything is flying around, any of these meme names, you got to be out of these names. They're going to get pummeled. You got to, what does well or relatively well in a recessionary? You got low vol stocks. Okay. That means defensive names. Okay. Get out of the high beta, go into low vol. That's if you want to position yourself for a recession. Now I'm going to show you this chart. To me, it's the most dangerous and frightening chart I've seen in quite some time, in a number of months. Okay, here it is: tax receipts versus interest expense. Okay, our government is spending money like a drunken sailor. Okay, this has always been going the wrong way, but we are seeing now unprecedented moves on interest expense. Part of it is we have a massive debt. And now that we are rolling over rates higher, okay, this is increasing the interest cost. Remember, over the last 10 years, okay, starting with the Obama administration during the financial crisis, we've been lowering the tenor of our debt. Instead of being, let's say, 5 years, it's now less than 2 years. So as this debt comes due, the rates are higher. So our interest expense is just automatically going up. We're about to we're going to be close to by the end of this year, like next, we're going to be $1 trillion in interest expense. Put it in perspective. We also have declining tax receipts. Already we're seeing that. Okay. Would you own a stock in a company that has declining revenues and massive interest expense? I wouldn't. Would you short that stock? I would. Okay, everyone needs to get mad here. These politicians have done this. Okay, I'm not going to get political here, but this is the bottom line. They print money, they spend money while taxes go down. And now we're in a really critical situation because, again, normalizing interest rates are taking our short-term debt higher. And every time new treasuries come, we got to roll over. They're coming at much higher interest rates. That means our interest expense is going up. And then compound that with a recession where taxes always go down. And then one last thing, we've got all-time high credit balances. That may hit a trillion in credit card balances by the end of the year. This is not good. Okay, what does this all mean at the end of the day? It means most likely a weaker dollar, 100% weaker dollar. Okay, no matter even if US rates go up, the dollar should weaken on back of this. How do you hedge yourself? Well, the obvious one's gold, commodity related, anything you can get your hands on in terms of commodities. Even Bitcoin may go up. I wouldn't buy crypto, but Bitcoin itself. Anything to hedge yourself against this problem that the US has got itself into. And I just don't see a way out right now, unfortunately. So if you're an investor, as always, be careful out there.